What's up, everybody? Welcome to the January 12th, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by Indy Wealth. Today, we're going to get right into those hot button issues, so let's get started. We're going to talk about politics here first. Politics, the Fed, and credit cards is kind of what I titled it. Over the weekend, we saw that there was a potential investigation into impropriety on the renovations of the Fed building. To be honest with you, I didn't see a lot of the details of that investigation. I did happen to see Chairman Powell's address of it, saying this was less about impropriety and more about the attempt of the administration to try to influence the Federal Reserve to adjust their policies. Which was interesting because Chairman Powell's tried to, I think for the most part, has tried to stay out of that fray. But this is obviously much more hitting closer to home, and he felt the need to respond, and he responded rather emphatically. The other one was President Trump, I believe it was on social media, reported that he is going to try to put forth a plan to cap credit card rates at 10% maximum for 1 year. And then who knows after that? I don't know if that's permanent. I don't know if it said 1 year cap. So I assume it expires after 1 year. But I didn't see a lot of the information on that either. Where I want to go with both of these is not so much in the nitty-gritty of those details, but really to take a step back, as I talked about this in my market update and outlook piece, is that over longer periods of time, your portfolio allocation really shouldn't be influenced by political environment. It is not a winning argument. Over longer periods of time, the markets are efficient, they're adaptable, and they adjust, and asset allocation should be much more based upon your personal circumstance rather than political influence. Still believe that with 100%. But what I'm going to say right now is it's harder to do, given that the current environment seems to be the markets are very focused on Washington because Washington has been intervening in places that they haven't in the past. Usually there was a pretty decent separation of some of the things we're seeing right now. That separation has eroded pretty quickly, and so the markets have looked to Washington for a lot of the activity, making it harder to avoid the noise. I still believe what I said before, and I'll stay to it again, is that noise, 99% of that does not create a portfolio action. The political influence is influencing the daily trades and the daily activities right now. You can argue that some of the policies set forth are projecting us further while hurting some other industries. You can absolutely make that argument. I totally get that. But to try to use politics as your long-term asset allocation strategy, I still think is a flawed segment. I understand it's much noisier now and it's much harder to ignore, but still you need to take a step back and understand that personal circumstances are going to be a much greater influence on how you should invest rather than what's going on in Washington. Turning to number 2, jobs and productivity. I think this will be a story for 2026. I talked about it in my market update and outlook piece. We're starting to see, I think most people who follow the jobs environment at this point right now are saying we're in a slow growth environment, kind of that low hire, low fire environment, right? We're not hiring a lot of people, but we're not having massive amounts of layoffs as of yet. But there is a big argument in saying how much is this driven by the productivity increases that we're seeing from artificial intelligence? And that's going to be a question, I think, for the rest of the year. I think every company on the planet right now is trying to figure that out. Like, how much incremental staff do I need to add for a couple of reasons? One, the cyclical environment. I need to know where the economy is, historical forecasting and what does our growth look like? How do we support that growth? Who do we need to hire for that? I think that's still absolutely viable. But I think there's another element at this point right now of artificial intelligence is how much can I get out of this current worker base if I give them the tools that make them more efficient in their jobs, that answer questions faster, that do the things that I need artificial intelligence to do so that I don't need incremental staff. I think that's an absolutely critical assessment that companies are going through at this point right now. So I don't see the reason that we're going to shift aggressively to hiring in the next year. But the argument is now pivoting a little bit amongst especially bulls on the street, which is absolutely fine. I somewhat get this argument is that, hey, a low growth jobs environment where we have high levels of productivity due to artificial intelligence is actually good for earnings because employees are expensive. So adding more of them are expensive and they could have a problem with margins, and we'll do better in margins with artificial intelligence. I have a little harder time with that as an argument. I get it. I understand it. But where I come from is the sentiment factor of jobs. Again, if people are worried about their jobs, or they're worried they cannot replace their job if they lose their current one, they're just not going to spend like they have been. I just believe that that is not an unbroken chain in the economy. We've been pretty resilient through 2025. Again, I think that K-shaped economy, I think that's still accurate. I think your mid to upper tier income component is feeling the wealth effect because everything worked really well in 2025. And so when you have that wealth effect, you feel like you can spend because you have a good job, you're making quite a bit of money, and now your portfolio is significantly higher. You're going to continue to do the vacations and things you want to do. But if you start worrying about your job, especially that mid to lower tier, and they start to worry about the things that they can't buy and they can't afford anymore, or just worried about, hey, if I lose my job, can I get another one? I really do think that's going to have an influence on spending. And spending, again, American economy is driven off American consumer spending. 70% of our economy is spending related and service related. So when you have those components of that, I think sentiment around jobs still has a pretty big influence on how we spend. And so therefore it has a pretty big influence on overall economic growth. I don't think that chain is broken yet. We'll see if I'm wrong. But I have a harder time believing that productivity alone and jobs, especially if we go from low growth to negative, to declining jobs, I have a real hard time saying we're going to still grow at the same rate we've been growing given productivity increases. I don't see that as my base case scenario. Turning to number 3, earnings season is going to begin here now. We got financials coming up probably first. It begins in earnest pretty much this week. I don't see real aggressive evidence that Q4, the numbers are going to be massively, negative or anything like that. I think actually will probably exceed a lot of the estimates that are out there. I do believe, and I said this in my market update and outlook piece last week, that I think the earnings growth for 2026, the estimate right now is almost 15%. I do believe that number is probably going to come down here as we go through earnings. And again, this is a game that we play a lot in Wall Street during January, is that companies come out and say, well, you've got this for us for a number. We're not sure if we're going to be able to do this, so we're going to bring numbers down. We're going to be a little bit more conservative in our growth outlook. And then Wall Street abides by that, and they bring their numbers down. It happens in a lot of Januaries. Some Januaries don't, but a lot of Januaries do. And I think we're going to see that here. It's always the question of how much we see that. If it goes from 14.5% to 11%, I really don't see it as a big market influence. We're fine. If we start to see that go down from 14.5 to 11, and then we're starting to see that continual drip downward, then we're in trouble just simply because we're at a pretty high valuation. And the valuation of the market, what we're paying for it, is a lot based upon this high level of growth. That high level of growth isn't coming through, then it's difficult to pay this level of valuation for the market. So I'm going to pay a lot of attention to what the companies are saying. Again, I don't see a real instance right now of 14 going to 2 from a growth perspective for 2026. It doesn't really happen that way unless you have an outside influence that actually comes in. I don't see that right now. So therefore I do think we're going to have a little bit of a step down in the earnings growth trajectory here. And then we'll see where that number starts to shake out. I don't see it as a large trending influence right now. We're not going to get ahead of anything from our portfolio allocation perspective, but we're going to be paying a ton of attention to what the companies are saying across the sector board to find out where the opportunities are and maybe where those risks are as well. Lastly, usually I do something personal here, and I try to do mostly fun stuff. This one obviously is not as fun, a little bit more of a somber note here, but I am born and raised. I'm a Northeast Minneapolis kid. I'm very proud of that. I loved my neighborhood. I have most of my friends that I still hang out with. We all grew up in that neighborhood. We love Minneapolis. Minneapolis is great. Northeast is great. My hometown is great. We love it here. I always say 46 weeks out of the year, I love living here. 6 weeks out of the year, not so much. And that's when the temperature is minus 20. So despite all the things you may be hearing about Minneapolis and all that stuff, it is a great place to live. I love my hometown. I am not leaving again. With the exception of 2 years in New York, I've lived here my whole life. I plan on staying here. This is a great place to be. It's a great community, and it's a community that's struggling a little bit right now. So all I'd ask for is a little bit of empathy, a little bit of compassion. Talk to your neighbors. Don't listen to social media about what this place looks like. If you want to know, talk to somebody who's from here, because we think it's a great place to live, and we're going to continue to live here through trials, tribulations, and eventually we'll get over this and we'll be prosperous again. So to the people who live in Minneapolis, stay strong, keep going. To the people who are wondering about this place, we're going to be okay, and it's a great place to live. Thank you very much. So that's it for us. Tune in next week where we'll have our next hot button topic. Until then, take care, and thank you, everybody.